Owning apartment blocks. Everyone says it's the ultimate real estate investment, but is it really the holy grail, or is it a risky move that could cost you big if you're not prepared? In this episode, we'll break down the truth about multifamily properties, separating facts from hype. You'll learn why these buildings have built massive wealth for investors around the world and the hidden dangers that could sink your financial plans overnight. The stakes couldn't be higher. If you don't fully understand both the potential and the pitfalls of apartment blocks, you could find yourself drowning in repairs, tenant vacancies, and market shifts. So stick around. This episode might just save you from the $1 million mistake. You know, this is interesting, okay? Apartment blocks, like I said, everyone considers them the holy grail of investment properties. Most sought after property, I would say, by investors, hands down. But why? Is it hype? Or is there more to it? Now, an apartment block is defined as a multifamily building with 5 units or more, at least according to Google. You probably already know that, so let's get into first what really matters: the advantages versus the disadvantages. Now, I touched on this a couple episodes ago when I was explaining about cap rates, but I thought I'd do this episode specifically about multifamily apartment blocks. I didn't want to talk about the calculations and, we were talking about profit and equity and appreciation. So let's just talk about the advantages and the disadvantages. Advantages. Number 1, economies of scale. Owning one building with 10 units is far more efficient than managing 10 separate properties. You've got one roof, one heating system, one tax bill, yet the same number of rental properties of income coming in, okay? Number 2, increased cash flow. With multiple units, cash flow can grow faster than in a single family property. Even if one tenant moves out, your other units are still going to generate income, and this reduces risk exposure from vacancy and turnover. Number 3, risk mitigation. In a single family rental, one vacancy leaves you with 0 income and having to pay that mortgage. But in a multifamily property, a few vacancies won't tank your bottom line, okay? I mean, really, that's what it is. It's safety in numbers. However, there is the other side of the ledger, the disadvantages. So number 1, bigger costs for repairs. So these economies of scale I talked to, it can also be a double-edged sword, because that roof, sure, only one roof, but that could be $150,000 to replace instead of $5,000. $5,000 roof on a house, that might be your average repair on a leak. So the same thing applies to boilers and other major systems. Talk about a $7,000 furnace or $150,000 to $300,000 boiler, okay? Concentrated risk. If something happens to your building, a fire, job losses in the area, new competition, your entire investment is at risk because all your eggs in one basket, all of your income is tied to one location. Let's explore that for a little bit. So we said if something happens to your building, okay, so let's say that you have a 40-unit apartment block and that's all in one area and there's a fire. Everybody gets evacuated. So all of those 40 tenants, let's say they're paying $1,000 a month, it's 40 grand a month gone. If you have, 20 houses paying $2,000 a month that are spread out around your city, your state, maybe over 3 or 4 geographical areas, those 20 properties times $2,000 for that each house is still $40,000. But a fire that displaces those tenants, one tenant, now you're down to $38,000. You don't wipe out your entire income, okay? We talked about job losses in the area. We have managed an apartment block in an oil and gas town, 15 to 20% vacancies, and it really depends on the time of year, what's going on in that oil and gas town, the price of oil. I mean, it's very, very volatile. And if you have an apartment block there, as opposed to 2 or 3 houses there, 2 or 3 houses maybe south, we're talking about Alberta here because there's a big oil and gas, in Fort McMurray, Alberta. But, you can find that in Texas. You can find that in any of those really volatile type of industries, mining, oil, where everything depends on that industry. New competition, maybe, they knock down the old apartment block next to yours that you've always enjoyed. You have a 1960s block, theirs was 1940s. You do the bare minimum and you're always getting very good tenants in there. Somebody buys that, they knock it down, they put up a huge, gorgeous complex with a pool. Now your entire investment is at risk because all your income, again, is tied to that one location. Okay, number 3, as a disadvantage, high upfront costs. Single rental property, it might require $50,000 to $100,000 down for a down payment. An apartment block, $500,000 or more. And if you don't have that, you're going to need to bring in partners, joint venture partners, maybe capital investors, and that not only complicates your cash flow, now you have a lot of cooks in the kitchen. Now there's people you're not sure you know. Now there's a lot of people trying to control everything here, even if you're the general partner. There's also regulations dealing with accredited investors, non-accredited investors, syndication funds, upfront fees. It's a big learning curve as opposed to, hey, I'm going to save $75,000 as a down payment to buy the single family rental and just throw it out on Facebook and rent it out. Another disadvantage, commercial financing. Apartment blocks fall under commercial real estate, meaning you're going to face different lending criteria and potentially higher interest rates. Now, lending criteria, are you a corporation? Are there different things that you're going to have to show with income? And don't forget, you're talking about a multi-million-dollar mortgage as opposed to $200,000 to $300,000 for a single family home. So it's going to be more difficult. This is my favorite thing, not my favorite, but my favorite thing to talk about because I know it very well. And Manitoba is a very tightly regulated province. Rent control, huge topic. Many markets impose tighter rent controls on multifamily properties than on smaller buildings. For example, here in Manitoba, that line is 4 units. And I'm going to do an entire segment on this very shortly in another couple of episodes. But that line is 4 units. So anything with 4 units and above in the province of Manitoba is subject to rent control. What do we mean by rent control? Well, that's the typical thing that you've heard where if the rent was $600 for the last 20 years and it has 4 units or more, you can't increase to anything but what the government allows you. And here in Manitoba, it's between 1.1 and a maximum of 3%. So what's 3% on $600? 18 bucks. And yet the market could be $1,300, $1,400, $1,500. Now we do have techniques here in Manitoba that we can do large renovations and get it off rent control. But again, it's risky. You need to know what you're doing. And that can really limit your ability to even refinance it later. So it's just different. So when you talk about rent control, it's fine. Maybe you can find what we call landlord-friendly states and provinces, Texas, Florida, province of Alberta here in Canada, where you're allowed to increase the rent, where you are allowed to evict a tenant and not renew their lease. Again, I'm being very general because as a professional property manager licensed in the province of Manitoba, I'll give you an example. We are actually not allowed to cancel a lease on a tenant. Every tenant in Manitoba has to have a lease renewal. Now, there are certain provisions, I'll call those exceptions if an owner's moving back in or you have the property for sale. But generally speaking, if you own an apartment block here, you can't just choose to not renew the lease on the tenant. And if you don't give them their lease renewal, it automatically renews for another term. And now you don't even get to increase the rent, okay? So rent control limits your ability to increase rents. Long-term profitability. Now, if you remember, I think 2 episodes ago, we talked about cap rates. And cap rates in relation to net operating income and eventual building value on that multifamily dwelling. If you can't increase your operating income because the rents are restricted, you're not going to be able to actually increase your net operating income except for maybe reducing expenses. Pretty hard to be able to get those cap rates to work in your favor if you have a lot of rent control. So now that I've laid out the challenges, let's shift gears and look at why so many investors, including thought leaders like Robert Kiyosaki, are obsessed with multifamily properties. What are the advantages? Okay, let's reinforce this. Rapid portfolio growth. If you buy one 10-unit building, it instantly increases your portfolio size and your rental income. It's really a faster path to scaling your business compared to buying one single family home one at a time, using the BRRRR method, pulling that out, going to a second one. I did it. I grew to 43 properties in 10 years, But arguably, if I hadn't been so stubborn, got some education, maybe some coaching at that time, maybe I would have transitioned into multifamily within 2 to 3 years. Maybe I'd be in a completely different spot right now instead of finally just doing my first couple of multifamily deals. Number two, consistent cash flow. We talked about this a few minutes ago. Multifamily properties generate multiple streams of income. It's stable. This stability attracts lenders. It can lead to favorable financing options. Number three, appreciation through that income. We're talking about those cap rates again, right? Make sure if you're listening to this and you want to get into multifamily, really understand about cap rates, about just how to evaluate deals like that, okay? Multifamily properties, they're going to be valued on that income rather than market trends. So they're not looking necessarily at what the previous apartment blocks in that area have sold for. It's always going to be based on the income appraisal approach. And this gives you direct control by increasing rents or reducing expenses to significantly raise the property value. We talked about tax advantages. So with a larger asset, you've got depreciation, operational expense write-offs. These can reduce your taxable income while your property appreciates. Again, not a tax expert. I'm going to sort of put that out there. Talk to your tax professional and see what the true write-offs you're able to do. But I promise you, there are a lot of tax advantages to multifamily properties. Demand and growth, that's another thing. So if you have urbanization trends and the increasing need for affordable housing continues to drive strong demand for multifamily units, this is going to ensure long-term tenant interest. We're talking about, if interest rates increase and people can't afford to be in housing, then they're going to have to rent, and they're going to want to rent in multifamily housing normally, because that's the easiest way for the government to, maybe they're giving a grant, maybe there's going to be a tax break or an advantage for new developments. Maybe they're going to give favorable financing for it. Who knows what's going to happen? I do know there is a housing crisis in both the US and Canada, and we're heading towards it, and all that's going to do is drive up rents because of a lack of demand. They need to increase the supply. I can almost guarantee that the government is going to be incentivizing multifamily builds and new starts. So let's talk about my internal debate, 25-year debate. You've heard me, if you've been following me for years, I've always advocated for single-family homes. I've been in this business for 25, 27 years. It's a long time. I always believed that single families and small multi offered better risk control, lower entry costs, and less complexity. And for many investors, they still do. I'm not saying that you shouldn't start with a single family home. Absolutely, you should. It's easy to get in. We'll talk about My First Keys community that I run, where we teach how easy it is to get your first rental property. And everybody needs to start there. You shouldn't be starting with a multifamily property. You should be learning how to be a landlord, learning how to be an investor, learn how to control tenants, really, learn how to have a property manager relationship, because when you get up into those multifamily dwellings, you're going to have to be dealing with property managers, and you better know how to understand operating statements, speaking to them in a certain language. And I'm not talking about profanity. I'm talking about operating language, maintenance. You have to be able to speak intelligently to a property manager to make sure that they are doing the right thing to protect your assets. So when I'm talking about that less risk, we're talking about lower entry costs, again, $75,000 to $100,000 to get your first property, less complex. But I'm also learning, and maybe not being so stubborn, but just looking around multifamily properties. If you're able to get into them, whether it's partnerships or syndications or joint ventures, when you're managing those correctly, they're wealth generating machines. I don't think anybody can really argue that. It's cash flow, scalability, and financial freedom at a level that just single family homes can't match. Just take a look around North America or the world. Some of the wealthiest investors got their wealth by owning apartment blocks, not single family homes. So which strategy is right for you? And the answer depends on your long-term goals, your resources, obviously, and your ability to manage complexity. So let's summarize, like I always do at every episode. Apartment blocks can unlock massive wealth or create massive headaches. It all depends on how you prepare. You've got to understand both the upside and the risks before you dive into a multifamily property, but you don't have to do it alone. I mentioned the My First Keys community. This is a group of like-minded investors, both beginners, savvy investors, multifamily investors that have scaled. Not only will you gain access to these exclusive people, resources, and expert advice, but I also go live once a month in a Q&A session to answer your biggest questions. And that could even extend to property management questions like, again, my tenant brought in a pet and I'm not sure what to do. Do I do a warning letter? How do I evict? We don't just teach you how to secure your first few properties. We show you how to manage them, and then we give you the tools to scale into multifamily buildings if that's what you want. Try out the full community for 6 weeks. No credit card required at My First Keys. Let's build your future together. Thanks for tuning in, and until next time, keep growing, keep learning, and keep investing to win.